Welcome back, everyone, to the Deep Dive, brought to you by the OneMoreStock channel. Today we're digging into Caris Life Sciences. That's ticker CAI. The One More Money blog recently did an analysis suggesting it might be, and I quote, the most undervalued AI plus healthcare stock right now. Big claim.
It's definitely a bold thesis. We're talking about a company right at the crossroads of AI, big data, and precision oncology.
Yeah, sounds exciting.
But like that analysis points out pretty clearly, it comes with significant risk. High potential, yes, but execution is absolutely critical here.
Exactly. And that's what we want to unpack for you today. We're going to go beyond the headlines, look at their core tech, really drill into those Q2 2025 financials, which seem like a major turning point.
A definite inflection point.
And then lay out the potential stock scenarios based strictly on the framework from the One More Money blog.
Yeah, the aim is to give you the context, the details you need to grasp why Caris is structured this way and why these latest numbers are so pivotal for where it might go next.
Okay. And just a quick heads up before we jump in. We are required to read a disclaimer at the very end. This is all for educational discussion. Definitely not investment advice.
Always important.
All right, let's get started with the foundation. What exactly is the Caris platform?
Well, Caris's whole reason for being is to basically revolutionize cancer care. They do this by integrating vast amounts of data, specifically what they call multi-omics.
Multi-omics. Okay. Break that down a bit.
So it's not just looking at a patient's tumor DNA. They layer on RNA analysis, protein analysis, the whole biological picture. And the really crucial part is linking all that molecular data to actual real-world clinical outcomes. How did the patient respond to this drug? What happened next?
So it's the molecular details plus the patient journey. That's the training data for the AI, I assume.
Exactly. That connection is vital. And this data generation fuels their two main revenue streams, which kind of work together.
Okay, let's hear about those. The One More Money blog highlighted this dual model.
Right. First, you have the clinical testing and molecular profiling. This is their bread and butter for clinicians. Think services like MI Profile, that's their tissue-based test, and increasingly important, Caris Assure.
And Caris Assure is the liquid biopsy, right?
Yeah.
Blood test instead of tissue.
Correct. Non-invasive, much easier logistically. That's a key piece we'll come back to.
Okay, so clinical testing is stream one. What's number two?
Stream two is pharma and data services. This is where the scalability really shines. They take all that aggregated, anonymized molecular and clinical outcome data they've generated.
From the clinical testing side.
Exactly. And they sell insights derived from it to pharmaceutical companies and research institutions. Think drug discovery, finding biomarkers, making clinical trials more efficient.
And I remember the analysis pointed out the margin potential here. Once you've run the clinical test and gathered the data, selling the insights from that data again and again. Well, the extra cost is pretty low, isn't it?
Yeah. Extremely low, relatively speaking. Much lower than running another physical lab test. That's a huge potential profit driver down the line.
So it creates this kind of self-reinforcing cycle.
Precisely. It's often called the flywheel effect. More clinical tests mean more data. They've reported over 900,000 molecular profiles linked to outcomes now.
Wow, 900,000. That's substantial.
It's a massive data set, and that data set is their competitive advantage, their data moat. It continuously trains and improves their proprietary AI algorithms. You might see names like GPSai and ABCDai.
Let's pause on those AI names.
Yeah.
GPSai, ABCDai, catchy. But what do they actually do with all that data?
Think of them as incredibly sophisticated pattern recognition tools. They sift through all that complex multi-omics data to find signals that older methods might miss, like predicting which drug combinations might not work for a specific patient.
Okay, avoiding ineffective treatments.
Or identifying patients who might respond surprisingly well to an unusual therapy. Or even helping pinpoint where tiny amounts of residual cancer might be hiding after treatment. They turn raw data into actionable clinical insights.
Which then makes the original clinical tests more valuable.
Driving more doctors to order them.
Which generates even more data for the AI. Got it. The flywheel.
And that puts them in direct competition with other big players, like Tempus, for example. It's a race to build the deepest, most comprehensive, multimodal view of cancer. The data really is the core asset.
Okay, understanding that data engine is key. Now let's connect it to the financials. Because Q2 2025, according to the One More Money blog, seems to have been a really significant quarter for CAI.
Oh, absolutely. It was a breakout quarter in many ways. Let's hit the highlights. Revenue came in at $181.4 million.
Well, $181.4 million. And the growth rate.
That's an 81.3% increase compared to the same quarter last year. Just huge growth.
81%.
And it doesn't seem like a one-off spike either. Their updated full-year guidance for 2025 is now between $675 million and $685 million. That implies something like 64% to 66% growth over the full year 2024. Sustained rapid growth.
Okay, impressive top line. But what really caught my eye in the analysis was the gross margin. That seemed to take a massive leap.
It did. That was arguably the biggest positive surprise. Gross margin expanded dramatically to 62.7%.
Up from what, about 37.5% the year before?
Exactly, from 37.5% to 62.7%. That kind of jump suggests they're finally hitting an operational scale where they can really leverage their fixed costs, the labs, the R&D infrastructure.
So volume is getting high enough to make the unit economics work much better.
That's the implication. And that margin improvement was critical for hitting two other major milestones in Q2. First, positive adjusted EBITDA.
Right. They reported $16.7 million.
And second, maybe even more importantly for market perception, they achieved positive free cash flow around $5.9 million for the quarter.
Okay. Crossing into positive free cash flow territory. That's a huge signal, especially for a company that IPO'd relatively recently, right? June 2025?
Yes. The IPO was in June 2025. And it valued the company around, $7.6 to $7.7 billion.
A hefty valuation.
Definitely. And that valuation came with high expectations. Moving out of cash burn mode and showing positive cash flow, even if initially small, starts to validate that valuation and fits the base case trajectory outlined in the One More Money blog analysis.
It shows the business model can be self-sustaining. But there's always a but, isn't there? The net loss was still quite high.
That's the key counterpoint, absolutely. Despite the positive adjusted EBITDA and free cash flow, the GAAP net loss for Q2 was still substantial, $71.8 million.
Which translates to a pretty big loss per share, 7.97 cents, I think.
That's right. Now, some of that loss is likely tied to one-time IPO-related expenses, stock-based compensation, things like that. But investors will absolutely need to see that bottom-line net loss number shrink significantly in the coming quarters. That's the main financial risk clouding the picture.
Okay, so improving operational metrics, but still a significant net loss to overcome. Let's talk about how they plan to keep the growth going and close that gap. The analysis points heavily towards Caris Assure. Why is that liquid biopsy test so central?
Several reasons. First, as we mentioned, it's a blood test. That makes it inherently more scalable than tissue biopsies, which require surgery or invasive procedures. Easier for the patient, easier for the doctor to order.
Lower barrier to entry.
Exactly. And that ease of use is critical for the really big future market opportunities, high-frequency testing.
You mean things like monitoring for cancer recurrence after treatment, that's minimal residual disease, or MRD?
Precisely. MRD testing needs to be done repeatedly over time. A simple blood draw makes that feasible. And the even bigger potential prize is multi-cancer early detection, or MCED, catching cancer earlier across many types using just a blood test.
Those are enormous markets compared to just therapy selection for late-stage cancer.
Orders of magnitude larger. If Caris Assure can prove effective and gain adoption in MRD and MCED, the potential test volume just explodes.
And the data supporting Assure looks promising.
It does. The One More Money blog cited a recent validation study for the MCED application. It showed sensitivity, the ability to correctly identify cancer, ranging from about 83% up to nearly 96% across different stages.
That sounds pretty good, especially for early stages.
It is. And crucially, the specificity, the ability to correctly identify someone as not having cancer was extremely high, around 99.6%. That's critical to avoid false positives, which is a major concern for regulators and insurers with early detection tests.
Okay, so the tech seems promising. Assuming Assure continues to perform well, what are the key things Caris needs to do, the main levers they need to pull, to get from positive cash flow to actual sustainable net profitability? The analysis identified a few, right?
Yes, basically three core drivers.
Yeah.
One, dramatically scale up Caris Assure volume. They need to get it adopted widely, especially moving into those high-volume MRD and potentially MCED uses. Volume is king.
Makes sense. What's number two?
Two, aggressively grow the data services revenue. Remember those pharma partnerships. They need more of those, leveraging that low marginal cost data asset to generate high margin income.
Got it. Scale Assure, sell more data insights. And the third
Third is achieving true operational leverage. As revenue grows, costs need to grow much slower. They need to maximize the efficiency of their labs, their sales force, their G&A expenses, spread those fixed costs over a much larger revenue base.
Scale Assure, boost data sales,
Yeah.
control costs. Sounds straightforward, but obviously challenging to execute.
Yeah.
What about things outside their direct control? The external risks.
Yeah, the One More Money blog was clear on these two. The biggest hurdle almost always in this space is reimbursement and payer coverage.
Getting insurance companies and Medicare to pay for the test consistently and at good rates.
Exactly. If payers drag their feet on approving coverage, especially for newer applications like MRD or MCED, it directly limits how quickly doctors can adopt the tests and how profitable each test can be. It's a constant battle.
Okay, reimbursement risk number one. What else?
Number two is intense competition. This isn't a vacuum. You have major players like Guardant Health, Foundation Medicine, which is part of Roche, Tempus, and others all pushing hard, particularly in liquid biopsy and early detection. Someone could innovate faster or secure a key partnership first.
So staying ahead technologically and commercially.
Yes. And the third major external risk is ongoing regulatory risk. Especially for game-changing claims like early cancer detection, you need continuous validation through published studies and ultimately formal approvals from bodies like the FDA. Clinical acceptance builds on that regulatory foundation.
Right, so they need favorable reimbursement, they need to outpace competitors, and they need to keep navigating the regulatory pathways. A lot has to go right.
You're essentially betting on their ability to manage all those external challenges while simultaneously executing flawlessly on those internal growth levers we discussed.
Okay, let's bring it all together. Based on that One More Money blog framework, how does this translate into potential investment scenarios over the next, say, 12 to 18 months? Let's start with the base case.
The base case assumes Caris basically delivers on its current promises. They hit that 2025 revenue guidance, 675, 685 M. They keep showing that strong gross margin expansion, and the path towards profitability continues even if net losses persist for a bit longer.
So, solid execution, meeting expectations. What's the potential outcome for the stock?
In that scenario, the market likely rewards them for validating the growth story post-IPO. The stock could trade at a moderate premium compared to peers, and the analysis suggested a potential upside of maybe 1.5 to 2 times the current price. It reflects them successfully growing into that initial valuation.
Okay, 1.5x to 2x for solid execution. Now, the optimistic case, what needs to happen here?
This is where things get really exciting. In the optimistic case, Caris Assure sees major breakthroughs. Think significant positive coverage decisions from major payers for MRD or even early signs of MCED adoption. Volume growth accelerates dramatically.
And the financials reflect that.
Yes. Revenue beats expectations, margin expansion continues or even accelerates, and critically, the net loss shrinks much faster than anticipated. Maybe they even approach or hit GAAP profitability towards late 2025 or early 2026.
Wow, okay, and the stock impact.
If that happens, Caris could really capture the market's imagination as a premier AI-driven healthcare growth story. This likely triggers significant multiple expansion, and the analysis floated a potential 2x to 3x upside, maybe even more from current levels. This is the scenario where that most undervalued thesis really plays out.
Makes sense. High reward if they hit it out of the park. But we need the flip side. The conservative or downside case. What goes wrong here?
Here, one or more of those key risks materialize significantly. Maybe reimbursement negotiations stall, or they only get narrow coverage approvals. Maybe Assure volume growth disappoints, or a competitor publishes stunning data that leapfrogs them in liquid biopsy accuracy or MCED performance.
Execution stumbles or external headwinds prove too strong.
Exactly. If that happens, confidence erodes. That premium valuation built on future growth looks shaky. The stock would likely face significant volatility, multiple compression, and the analysis suggested potential downside of 20–30% or even more. Investors caught here are the ones who didn't track those execution milestones closely enough.
So putting it all together, the picture seems clear. Caris Life Sciences. Definitely high growth, operating in a potentially transformative field AI plus precision oncology, but carrying very significant near-term execution risk.
That sums it up well.
For a long-term investor, maybe someone with a 3 to 5 year view who truly believes in this convergence of AI and oncology, maybe it's a core holding to consider understanding the bumps along the way.
Potentially, yes, if you have high conviction in the theme and their platform.
But for anyone looking at a shorter or medium-term time frame, it seems the focus has to be almost entirely on tracking those specific catalysts. News on reimbursement, FDA interactions, Assure volume trends, competitive updates. Execution is everything.
Absolutely. The technology is impressive. The Q2 turnaround provides a strong foundation, but really, it just bought them the opportunity to prove they can scale and achieve sustainable profitability. The next, maybe 2 to 4 quarters, are going to be incredibly telling. We need to see clear progress on payer wins and assure volume scaling. That's the bottom line.
A very clear takeaway. Which brings us to our final required segment for this deep dive. Okay, the necessary reminder. This deep dive is purely for educational and informational purposes. It absolutely does not constitute investment advice. Please always conduct your own thorough due diligence before making any financial decisions. All right. Thank you so much for tuning into the deep dive on the OneMoreStock channel. If you find this kind of analysis of U.S. stocks valuable, please do subscribe to the channel so you don't miss out on our future deep dives. We'd love to hear from you. Please like this video if you found it helpful, and definitely leave a comment below. Let us know what you think about Caris Life Sciences specifically based on what you've heard. Will you buy or not? We're curious to see your take. Thanks again for watching. See you in the next deep dive podcast.